So, good afternoon, everyone, and welcome to the monthly Eurosif Sustainable Finance Update. We hope everyone enjoyed a nice break during the summer period, or at least benefited from things being a bit less hectic. As always, thanks for taking the time to join us today. During our session today, we would like to provide you with a recap of the most notable regulatory and policy developments that occurred just before and during the summer break, and then also give you a sense of what to expect in the coming months, particularly in relation to SFDR. So with that said, let's take a quick look at our agenda for this afternoon on the next slide. Today, we're going to provide you with a brief recap of the major regulatory and policy developments relevant to the sustainable finance framework that occurred before the summer. Then we will give you an update on the state of application, as it were, of SFDR, where we will present some interesting data on the evolution of the market in SFDR products. We will also outline what regulatory developments you can expect in relation to SFDR in the coming months. We will then move on to the Commission's call for input to the ESAs on greenwashing, which became public in mid-August. And finally, we will provide you with an overview of the Platform on Sustainable Finance's most recent report on compliance with minimum safeguards under the taxonomy. So throughout the updates, we would welcome any questions that you might have. We also hope to have time at the end for Q&A. If not, please do not hesitate to contact us after the session if your questions have been left unanswered. Also, as always, the slides will be made available on our website after the session today, and you will also be able to find a link to the slides in the description below after the live stream is over. Also, of course, the playback of this session will be available on the Eurosif YouTube channel. So with all of that said, let's dive into the first item on the agenda and set the scene for the rentrée. So with that, we can move to our next slide. So many of you will, of course, already have heard of many of the developments I'm about to cover, especially if you regularly follow our updates. Nevertheless, I think there is a bit of value in just setting the scene for everyone and reminding everyone of what has happened in recent months. So first, of course, on the 6th of July, the European Parliament allowed the Complementary Delegated Act, or CDA, including natural gas and nuclear energy in the EU taxonomy, to pass. Of course, an objection to the CDA had been tabled, but MEPs voted against the objection during the July plenary of the European Parliament. The CDA was subsequently published in the official journal of the EU on the 15th of July. So turning quickly to the Corporate Sustainability Reporting Directive, or the CSRD, trilogue negotiations between the European Parliament and the Council concluded on the 21st of June, with a provisional agreement having been reached. On 29th June, the Council voted on and approved the provisional agreement with the European Parliament. Subsequently, on 14th July, the Legal Affairs, or URI Committee of the European Parliament also approved the provisional agreement in a vote. Now, the CSRD must be subject to a vote in the plenary of the European Parliament. The vote is not yet listed on the agenda of the next plenary session in mid-September, but we can expect it to take place in the next 2 to 3 months. This vote is largely a formality, and we expect the plenary to validate the vote of the URI committee. Of course, the next step after the vote in plenary will be publication in the official journal, and thereafter member states can start to transpose the directive into national law. So moving to the next slide, and also onto the SFDR. The delegated regulation containing the detailed disclosure requirements and disclosure templates for SFDR was published in the official journal on 25th of July. And then finally, just in terms of setting the scene, providing a recap, MiFID II and IDD requirements on integrating client sustainability preferences during the advisory process entered into application on the 2nd of August. So that is just a very quick overview of the main developments that occurred over the course of June, July, August. Now we can move on and take a closer look at the SFDR. So, of course, as we've just mentioned, the delegated regulation containing the detailed disclosure requirements and templates for SFDR will apply fully as of 1st January 2023. Now, as we are all acutely aware, financial market participants, FMPs, have been attempting to comply with various aspects of SFDR since 10th March 2021. Despite all the delays in the implementation of technical standards, and also, perhaps more fundamentally, the lack of necessary data to make disclosures. Now, in this context, the ESAs published a report on the extent of voluntary disclosure of principal adverse impacts at entity level. And just to remind everyone, this should take the form of a PAI statement. Now, for clarity, the report looks at the quality of PAI disclosures of FMPs that are under the 500 employee threshold and thus not obligated to publish a PAI statement. So of course, it is voluntary disclosures that the ESAs are examining. So if we move to the next slide, we can tell you that for the purposes of this report, the ESAs gathered information from national competent authorities, NCAs. Now, somewhat unsurprisingly, the report's findings indicate that the extent and quality of voluntary PAI disclosures vary quite dramatically from FMP to FMP and across national markets. So, in effect, the ESAs have found that the PAI statements that are published voluntarily by FMPs are often vague, and they lack sufficient detail to really outline or make it clear how the FMP identifies and mitigates PAIs. For the most part, PAI disclosures made by larger FMPs tend to be superior than those of their smaller peers. That is quite logical when you consider larger FMPs are likely to have more resources. But it's important to note it's not always the case. On occasions, NCAs have been disappointed by the effort made by some of the larger market players that can make voluntary disclosures. Now, what we found interesting when reading this report by the ESAs, when asked to justify why their PAI disclosures were vague, or indeed to justify why they didn't make voluntary disclosures of PAI statements, FMPs cited the lack of data on PAIs, difficulty calculating PAIs, incomplete or pending implementation of technical standards, and of course, prohibitively high cost of compliance. And so these, again, are the reasons cited by FMPs for either non-disclosure or poor quality disclosures. Now, the ESAs, of course, acknowledge the challenges. They do, however, note that as of 1st January 2023, when the disclosure templates and technical standards apply, they expect an improvement in the quality of disclosures related to the PAIs. An important thing to note, this report was published by the ESAs pursuant to Article 18 of SFDR. It is an obligation the ESAs are under to publish this report every year. The ESAs at this juncture do not envisage any specific action on the back of this report, but they are gathering examples of best practice with the help of NCAs. Now, if we move to the next slide, we can present you otherwise with some interesting data on the market in products classified in accordance with SFDR. So, of course, in addition to the ESA's report on voluntary disclosures, at the end of July, Morningstar published data on the market in Article 8 and Article 9 products. Specifically, the Morningstar data relates to the evolution of the market in Q2 2022, but it builds on previous quarterly reports. Now, the most notable findings of Morningstar data is that Article 8 and Article 9 products now account for over 50% of EU assets, with a collective monetary value estimated at 4.18 trillion euro. So it's very substantial. And as anticipated, Article 8 and 9 products, now effectively account for over half of EU assets. Now, in Q2 2022, moreover, 60% of new funds were classified as Article 8 or 9 at launch. In terms of existing funds, up to 700 funds were reclassified, most being upgraded from Article 6 to Article 8. However, what is most interesting from our perspective is that there were 17 funds that were demoted, for lack of a better term, from Article 8 to Article 9. Or sorry, rather from, I got that right, Article 9 to Article 8. Now, this occurrence of Article 9 products being demoted is something that may become more frequent in the months to come. Anecdotally, we've heard of quite a lot of asset managers that are uncomfortable classifying some of their funds as Article 9 and have, expressed, misgivings over that and maybe indicated that they will reclassify those Article 9 funds to Article 8 funds in future. Now, interestingly, in terms of SFDR disclosures, Morningstar data indicates that only 50% of Article 8 and 9 funds disclose consideration of PAIs. So that is quite surprising. It's a low or lower than expected figure. Then with regard to taxonomy disclosures, only 25% of Article 8 and 9 funds disclose taxonomy alignment figures. And pretty dramatically, out of that 25%, 90% of products indicate zero alignment. Now, from our perspective, this clearly reflects the impact of the Commission's Q&A from just before the summer, in which the Commission clarified that if data on taxonomy alignment was unreliable, FMPs should indicate zero alignment for their products. And I suppose this Morningstar report then came at a very opportune moment to demonstrate the impact of that clarification from the Commission. Clearly, most FMPs are not confident in the reliability of what taxonomy alignment figures are available, either from companies or third-party data providers. And they have opted to indicate zero taxonomy alignment rather than stick their neck out and put a figure out there that they can't really stand behind. Otherwise, focusing for a moment on Article 9 products solely, Article 9 products vary very dramatically in terms of their exposures to sustainable investments, as defined by Article 217. And, in some cases, well, the data indicates that in nearly 40% of cases, Article 9 products only have about 50% of their assets qualifying as sustainable investments. Now that again is quite low, and we expect that this will likely be considered as unsatisfactory from the point of view of supervisors, in view of the Commission's Q&A from July of 2021, in which they stated that Article 9 products should invest exclusively in sustainable investments, save for a few instruments for hedging and liquidity purposes. So if an FMP is offering an Article 9 product that only has 50% exposure to sustainable investments, that may be an Article 9 product, how to put it, which is sort of eligible for demotion. Now, finally, an important point made by Morningstar, or observation rather made by Morningstar, that actually concurs with something Eurosif anticipated in its SFDR report and policy recommendations, is that financial advisors are going to be having difficulty complying with their MiFID II requirements on integrating client sustainability preferences. And this is, of course, due to the lack of data and the non-comparability of products. So that is, a very valid observation made by Morningstar. So with that overview of the state of application done, we can now move on to the next slide and just provide you maybe, or apologies, yeah, the next slide again. But we can just provide you with an overview of what to expect in terms of SFDR regulatory developments in the months to come. So as many of you probably recall, by 30th of September this year, the ESAs are required to propose additional taxonomy-related product disclosures to ensure that exposures to natural gas and nuclear energy are reflected. And of course, this is a direct consequence of natural gas and nuclear energy being included in the taxonomy as transitional activities pursuant to the complementary delegated act. So of course, once the ESAs produce these draft additional taxonomy related product disclosures, they will have to be incorporated into the SFDR delegated regulation that was published in the official journal on the 25th of July. So the delegated regulation will undergo a few changes, and it will have to be amended to include these additional disclosures developed by the ESAs. Also, of course, in October, we are expecting the ESAs to publish a Q&A document that will seek to address a number of practical challenges in applying the SFDR. So of course, given that the three ESAs are involved, and also the huge volume of questions that they've received from industry practitioners. It may not be in October. It could, of course, be later. The timing of these documents is always difficult to determine. But I am at least told that it will be a very comprehensive document. Now, whether that means it will be satisfactory is another question, but at the very least, the ESAs are going to make a big effort to clarify how to apply SFDR. And then I suppose finally, the ESAs have been mandated to review the PAI framework and propose revisions to streamline and refine existing PAIs, extend the list of mandatory PAIs, and improve the methodologies and metrics used to calculate PAIs. And of course, the ESAs must deliver on this mandate by Q2 2023, approximately. Now, it hasn't been confirmed to us privately, but it's likely that any revisions to the PAI framework that the ESAs develop, they will likely subject to a public consultation between now and Q2 2023. But again, we can't really say that with certainty. That is what we would expect as sort of a proper process, but the ESAs also have quite a lot on their plate. So if they're unable to conduct a public consultation, that also would not surprise me. So I suppose, that is the update on SFDR, largely, finished. With all of that said, I'll pause here for a moment to see if there are any questions concerning the recap and concerning SFDR. All right, well, if there are no questions at this point, of course, please feel free to post questions in the chat and we can revert back to you at the end of the session. But if there are no questions, now I will pass you on to my colleague Viviana for an update on the Commission's call for input on greenwashing. So Viviana, please go ahead.
Thanks so much, Hugo. So another interesting publication that actually happened during the summer is that the European supervisory authorities, the so-called ESAs, which include ESMA, EBA, and EIOPA, actually published a call for input on greenwashing risks and the supervision of sustainable finance policies that was sent by the European Commission on the 16th of May. But why the Commission decided to send this call to the ESA? Because actually this call is linked to the strategy on financing the transition to a sustainable economy, which outlines steps under Action 5A to monitor greenwashing risks and assess whether supervisory mandates and powers are effective in addressing these greenwashing risks in cooperation with the ESAs. But why is so important this call? Because as we know, the demand for sustainable investment is growing rapidly. However, this should not come at the expense of greenwashing practices that can affect investors, consumers, and financial market participants, and potentially undermine the overall trust in sustainable finance and the capacity of the financial system to channel private capital to sustainable investment. That's why this is very important that the Commission request each of the ESAs individually, but in a coordinated manner, to provide their respective input by means of a progress report and a final report. So the first one, the progress report, should take stock of the work undertaken to date, so focusing on how greenwashing is understood and where it might materialize, but also action taken and tools developed to ensure adequate monitoring of greenwashing risks and early supervisory challenging, both in monitoring the application and enforcing new policies. This progress report is requested in 12 months, so in 1 year after this call has been sent. So in this case, should be ready by 16 May 2023. While the final reports, so there is a second report that should be made by the ESAs, and this report should build on the findings of the previous reports of the 1 year before, and of course complement them, for instance, by providing examples of greenwashing cases and assessing their impact on the financial market. Or also the ESAs, the commission suggested to assess the implementation of policies aimed at preventing greenwashing. In this case, this report is requested in 24 months, so 2 years after the date this call has been sent on the 16th of May, so should be ready for the same date in 2024. Both this report is really important, need to be accompanied by a shared summary of key horizontal aspects across all 3 reports prepared, of course, by the ESAs, in order to allow a certain degree of comparability across the reports and the findings that the ESAs will explain in these reports. But it's very interesting to understand, like, more deeply what we can expect from these reports, and we can see these in the next slide. And what the Commission is really asking for is that the ESAs should coordinate their input and ensure coherence across the approaches taken for the reports, in particular for the terminology of greenwashing across all the sectors. So the Commission underlined this point very well. But more specifically, the ESAs need to provide this input from a legal and a practical point of view. And on these 6 areas we can see here in the slide, starting, of course, from the basis for this report, that is the greenwashing and the risk of greenwashing. In this case, the Commission asked the ESAs to assess the scale of potential greenwashing and how frequently this can occur in the market, but at the same time collect information on the most frequent greenwashing situation and compliance, and at the same time can also give like some analysis on identifying and assess risks that greenwashing poses to financial sector entities, investors, and consumers. Of course, the ESAs, in order to obtain this information, to collect this information, can base their input from national authorities, researchers, but also, when it's appropriate, of course, they can even open a public forum for evidence for the financial market participants in order to understand really what is the situation regarding greenwashing. According to that, of course, there is the second topic that the ESAs should address, and in this case, the reports in the second topic are expected to offer an overview and assessment on the most relevant supervisory practices and tools that, of course, national competent authorities have developed in this year and, of course, the next year to define, capture, and address greenwashing cases, or of course the greenwashing risks related to these cases. So, for instance, while of course the implementation of the SFDR is ongoing, and we need still to keep in mind that national practice can differ, in this case the ESAs are also asked to include ideas and suggestions for the Commission to support the supervisory in their roles here in this implementation of the SFDR. And this particular point will bring us to the third area of analysis that should be addressed by the ESAs, because here the Commission wants the reports to include the current state, of course, even the 23 and 24, the state of the implementation and application of relevant sustainable finance policies, and also legislation. These legislation and policies that aimed at preventing greenwashing or address at least greenwashing risks. But at the same time, still in this area, the Commission expects that an assessment of how national competent authorities are implementing the supervisory obligation related to sustainable finance disclosure under still both the SFDR and the taxonomy regulation. Here, then we have this fourth topic, where in this case, the report should include an early assessment of what supervisory and enforcement measures are necessary for the national competent authorities, still to identify, prevent, or anyway investigate about greenwashing in the financial market. And here the Commission has specified that they can include suggestions like supervisory measures that are adopted by the national competent authorities, or in particular the challenges in adopting them in the current, like in this year, that we will able to understand better when the report will be released. And this will bring us to the fifth topic that actually is really important here, because the ESAs in these cases are requested to assess whether the current and forthcoming supervisory mandates and the toolkits that now and in the next 2 years are available to the national competent authorities are actually fit and work to identify, prevent, investigate the greenwashing, and of course sometimes can also address greenwashing risks. This fifth topic, of course, will have an important role to have in the sixth area of analysis that the ESAs need to address, because of course the ESAs are invited by the Commission to provide insight of improvements for the current regulatory framework, of course, based on observed and experienced potential shortcomings that they could understand in the rest of the analysis. So if there are like inconsistencies, conflicting concept, gaps in the regulation, including in the level 1 of the legislation. And here one important things to note is that the Commission has also underlined that these advices should not prejudge any legislative action from the Commission that the Commission should like implement in order to fix this issue. So after all these analyses and well-explained reports that will be published in the next couple of years, based on this input, what can happen? So the Commission, as explained, that will assess and monitoring greenwashing risks in the financial market based on these inputs given by the ESAs. And on the meantime, there is still the implementation of key policies. And of course, we'll consider whether further steps are necessary for effective supervision and enforcement in the context of greenwashing and risks. One last point that is really important that the Commission underline in this call is that the Commission, thanks to these really deep analysis from the ESAs, can also consider potential amendment to the existing rule book, of course, if needed, thanks to the analysis of the ESAs. With this last point now, I can pass the floor again to my colleague Hugo for a couple of comments regarding this significant call for input to the ESAs. Thanks.
Many thanks, Viviana. So just one or two comments to add before we move on to the next item. In a political context, one of the things that is significant about this call for input is, from our discussions with staff in DG FISMA, we know that at political level within the Commission, there is not any great appetite at present to reform existing sustainable finance regulation. So SFDR in particular. And the reason there's that unwillingness politically to do anything to rectify some of the shortcomings in the framework is simply just because of how difficult it's already been to implement the framework. And so it's unlikely in the next 2 years that we're going to see any sort of drastic reform. And requesting that the ESAs prepare these reports is sort of a way of providing a bit of cover for DG FISMA and for the Commission generally. What we're expecting to hear, in future in private conversations is DG FISMA telling us, oh, well, we must await the outcome of the ESA's reports before we can take any action. That is why the timing of these reports publication is very important. If the final reports are published in May 2024, that will be just after or during the next European elections, and there will be a new commission entering office and starting its mandate soon thereafter. So I think one of the intentions with the report is to provide a list of issues that have to be addressed during the next mandate. But in the intervening periods over the course of the next 2 years, we shouldn't expect too much action to address things, say, like the definition of sustainable investment in SFDR and the vagaries of it. But I just wanted to add that quickly to Viviana's comments. But I'm conscious of time and we should move on to our next item. So I'll pass the floor to my colleague, Federica. So Federica, please go ahead.
Thank you, Hugo. Indeed, on the 11th of July, the Platform on Sustainable Finance published a draft report with advice and recommendation on how to assess compliance with minimum safeguards as required in the taxonomy regulation. So the draft report is open for public consultation now until the 6th of September. And after reviewing the responses and feedbacks received, the platform will finalize the report and submit it to the EU Commission as a technical advice by the end of September. After that, the Commission will assess the opportunity of issuing additional guidance on the topic. So a brief refresher, what are minimum safeguards? So as we know, to be considered as taxonomy aligned or sustainable, an economic activity must satisfy certain criteria, including minimum safeguards. So as per Article 18 of the taxonomy regulation, minimum safeguards are procedures that companies put in place to ensure the alignment with certain international standards and responsible business conduct, and in particular, the OECD guidelines for multinational enterprises, the UN Guiding Principle on Business and Human Rights, 8 fundamental conventions of the ILO, which is the International Labour Organization, and the International Bill of Human Rights. So in other words, the objective of introducing minimum safeguards here is to ensure that economic activities that are aligned or instrumental for the green transition are not labeled as sustainable or green when they involve negative social impacts. So with that said, we can move to the next slide. So what's in the report? So the objective of the report is to provide advice on how compliance with minimum safeguards should be assessed. For instance, what are the criteria that investors should consider in order to determine whether a company in which they have invested or in which they will invest is taxonomy aligned? So first of all, the platform identified 4 substantive topics for which compliance with minimum safeguards should be defined, which are human rights, including labor and consumer rights, bribery, bribe solicitation and extortion, taxation, and fair competition. So these are the topics that should be assessed or analyzed to verify whether a company is compliant or not with minimum safeguards. So compliance with minimum safeguards combines consideration on processes and considerations on outcomes. More practically, and considering, for instance, as an example, human rights. In order to determine the compliance and the non-compliance with minimum safeguards, investors must be able to verify, 1, whether the company respects human rights, so the outcome, and 2, whether the company has established a proper due diligence process on human rights according to the 6 steps outlined in the UN Guiding Principle and the OECD guidelines. So here we are on the processes. So according to this approach, the platform delineates 2 criteria, and we are already arrived at a subsequent slide. The criterion 1 is the existence of adequate due diligence processes, and the criterion 2 is aimed at identifying whether the company has been convicted on a breach of human and labor rights due diligence laws, and whether the company is properly engaging with stakeholders. So further guidance, so here we provided an example on human rights, but then the report also provides further guidance for the other three topics: bribery, taxation, and fair competition. But generally speaking, we can say that the criteria apply this logic. So procedure on one side and outcome on the other side. Both these aspects, both these approaches should be taken into consideration. Another thing that is interesting to observe is that minimum safeguards screening must be performed at a company level. So we are talking here about companies rather than economic activities, as for instance is the assessment of other technical screening criteria, which is another criteria to verify the alignment with the taxonomy. So another interesting point that the report addresses is how this system will fit the EU regulatory framework on sustainable finance. And on this point, it is worth underlining that the Corporate Sustainability Due Diligence Directive, which is now under discussion, will introduce, as we know, provisions on the adoption of adequate due diligence processes. On the other hand, the Corporate Sustainability Reporting Directive, which we just talked at the beginning of this sustainable finance update, with the corresponding reporting standards, will introduce provision on the disclosure of information on the due diligence. So these pieces of regulation would be very important in order to enshrine this process of ensuring minimum safeguards further in the EU regulatory framework. Just to conclude, I think it is very worth to underline a couple of observations on the current state of implementation of minimum safeguards, which are discussed in the report. So first of all, the platform recognizes that companies, investors, auditors, and all stakeholders involved are struggling to understand what minimum safeguard mean and how compliance should be determined. So a key challenge here is identified again in data availability. So as we saw before for the PAIs in the SFDR, data availability and data quality is always an issue. Second point, interestingly, and as a consequence for lack of data, investors are increasingly turning to external data analysis and research providers to obtain tools for taxonomy alignment assessment. So by reviewing the products of 4 providers, the platform has realized that each one considers different topics to assess the compliance with minimum safeguards. Moreover, and interestingly, there is a significant difference in the approach. So some providers look at the existence and severity of allegations or cases of human rights abuses, for instance, by offering the popular controversy screening products. Other providers also analyze whether and how a company implemented human rights due diligence processes. So when the second approach is adopted, which is also compliant on what are the criteria and the recommendation described by the platform, it is evident that only just a few companies have yet implemented the steps outlined in the UN guiding principles and the OECD guidelines. So providers that adopt this second approach, so they don't just look at the abuses or the allegations, but also try to analyze whether due diligence processes have been implemented. Well, here the number of companies that are compliant with the minimum safeguard provisions and consequently with the taxonomy is lower. And one last observation before closing, according to the platform and what they outline here in the report, we cannot use only controversy screening to ascertain compliance with minimum safeguards. Why? Because we might consider as taxonomy aligned many companies that do not carry out appropriate or do not carry out at all due diligence processes on human rights, and therefore would be in breach of Article 18 of the taxonomy regulation. In other words, the fact that a company does not have allegation or is not incurred in cases of human rights abuses doesn't mean that it has always and also introduced appropriate due diligence processes, which is required according to this analysis of the platform to verify minimum safeguards. So I see that our time together is finished. So I will stop here, but I will be more than happy to provide any responses to questions also by email on this topic. So with that said, I will pass back the floor to my colleague, Hugo, for the final comments and to close this section. Thank you very much.
Many thanks, Federica. So also thank you to everyone for taking the time to join us this afternoon or also to watch back the session. Please feel free to contact the Eurosif team if you have any questions in relation to what we covered in today's session or other sustainable finance topics. Unfortunately, we encountered some technical difficulties during the live stream, and so you will have to look at our YouTube channel to find the full video. You will also find the slides used during the session today in the description below for your ease of reference. Many thanks for joining us again, and apologies for any interruption to the stream. Thank you, and see you during our session in October.